Welcome to our deep dive into today's really dynamic market outlook. We're seeing this fascinating tension, aren't we? Global instability pushing one way, but then you've got surprisingly robust corporate earnings pulling the other. Our mission here is pretty simple. Cut through the noise, deliver clear insights on what's really moving things this week, and importantly, what it means for you.
Exactly. Yeah, we'll be looking closely at the major U.S. benchmarks. You've got the S&P 500 hovering around, 5,200, NASDAQ Composite near 17,000, and we'll explore those key factors shaping how investors are feeling right now.
Okay, so the big headline.
Yeah.
These U.S.-Iran military strikes. My first thought, like many I imagine, goes straight to oil. Is that where the market's reacting most immediately, or elsewhere too?
You're spot on. Oil is definitely a major focus. Brent crude jumped nearly 18% since June 10th. It's pushing $80 a barrel now, and that immediately sparks inflation concerns, right? If it keeps going, well, more pressure. Beyond oil, though, we're seeing broader ripples. Analysts warning about a sell-off in riskier assets and a clear flight to safety. You know, the usual suspects.
Yeah.
The dollar, treasuries.
Right. So not just the commodity itself, but this wider sort of nervousness, a de-risking. Okay, beyond the geopolitics, the Fed is always top of mind. How did they react this week, especially with inflation still being, well, sticky? Any surprises?
No real surprises on rates. They held steady, and they reiterated those concerns. Inflation, quote, elevated. The language they used, it strongly suggests no cuts anytime soon. September, maybe later. We've got data next week, too. Housing, PCE, inflation, the Fed's preferred measure, of course, and business surveys. All that could just reinforce their cautious stance. It's very much wait and see, but mostly wait.
Wait and see, but mostly wait. I like that. So that cautious Fed tone, plus the geopolitical heat, it creates a pretty complex picture. How are the big analysts making sense of it all? Are they leaning bullish, bearish? Is it like a total split?
Well, what's interesting is how many are leaning the same way. Cautious to bearish, mostly UBS, for example. They expect volatility to continue this summer. Advising defensive positions, they point to valuations being quite rich, S&P 500 around 22 times forward PE. That's historically high.
22 times, yeah.
And then you have BCA Research's Peter Berezin. He's forecasting a potential downside, a pretty significant one, roughly 25% drop for the S&P 500, targeting around 4,500. Citing weakening fundamentals, and David Bianco at DWS warns of maybe a 20% summer correction, again, pointing to overvalued markets, about 23 times earnings, plus all the macro uncertainty. It's sobering.
Oh, yeah. A 20 or 25% drop, that would definitely grab headlines and wallets. But markets aren't usually a one-way street, are they? Where are the glimmers of optimism? What's supporting a more positive view?
Absolutely. It's definitely not all doom and gloom. Earnings growth expectations, they actually remain positive, projected around 7 to 15% for 2025. And earnings have consistently surprised on the upside, actually, especially in, AI, the Magnificent Seven tech stocks. They're still showing incredible strength.
Right, the tech engine keeps firing.
Exactly. And equities have bounced back, too, remember, from that April weakness driven by tariffs. Share buybacks have resumed. Sentiment among retail and institutional investors seems to be improving. So the underlying corporate health in certain pockets, it's still quite strong.
Okay, so pulling all these threads together then, geopolitical tension, a Fed that's holding firm, the split between analyst caution and decent earnings strength. What does this actually mean for you trying to navigate these signals day to day?
I think overall the immediate takeaway, expect a choppy market next week, reactive. While the medium-term picture, it probably still supports some cautious optimism, especially around tech, as we said. There's a real risk, a non-negligible risk of drawdowns, pullbacks, those high valuations, the macro uncertainty. It's a market where you really need to watch the headlines closely.
So for investors thinking longer term, what's a sensible approach right now?
I'd say maintaining a diversified, balanced approach is key. Maybe paying closer attention to defensive sectors, things that hedge against inflation, that could prove wise over the next few weeks, maybe months. It's about building resilience, really, not just reacting to every single wobble.
That definitely raises a crucial question for everyone listening. How will these triggers geopolitics, key economic data coming up? How will they shape your long-term view on market resilience? And where the opportunities might lie next? Something to really think about in the months ahead.